This is Mr. Port,
This is my daughter Cam.
and we're here with the Geico Lizard Martin.
From our Geico Gecko Martin, right?
Yeah, and we are going to be learning about insurance. Fun!
All right, so let's start off with a quick insurance commercial.
Hey, who are you? Oh, hey, Jeff, I'm a car thief. What? I'm here to steal your car because, well, that's my job. What? 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 It happens. And you got covered car insurance, paid for this, could feel like getting robbed twice. Get all stable. And you're better protected from mayhem. Like me.
All right, so we're going to talk about insurance today, and hopefully you guys have good insurance, especially if you're out and about driving as a young teen or as you get older too. And there's all kinds of insurance that we want to go over that you want to make sure you have. So what is insurance? Our basic definition of insurance is this. It's a contract where one party, the insurer, so that's the insurance company, agrees to pay another party, the insured. So that'd be you or I, the person that has the insurance policy, for losses affecting the injured's interest. So it could be homeowner's insurance, it could be life insurance, it could be auto insurance, any type of insurance, health insurance, where the person that is insured is getting paid a sum of money to protect them or to pay for some kind of damage. So there's two terms that we have to understand with insurance. The first one is premium and the second one is deductible. A premium is the amount of money that you pay monthly or yearly or every 3 months or however often you pay your insurance bill. That's what you pay to have the insurance, okay? So the deductible piece, though, is very important because a lot of students will think, okay, I pay my premium, that's it. My insurance is paid for, I'm covered. If I get in a car accident, I'm good to go and I'm covered. But you got to know what your deductible is. So when you're shopping for, let's say, auto insurance, what's your deductible going to be? Because that's what you're going to have to pay at the moment of an accident to get your car fixed. So your premium is just giving you the right to have insurance. Okay, your deductible is what you're going to have to pay in order to use your insurance. All right, so you might have, let's say, a $500 deductible with your auto insurance. You get in a car crash. You're insured, you have insurance, so you're legally driving in the state of Illinois. You go to the auto shop to get your car fixed, and you find out, or you call your insurance company and you find out you have a $500 deductible. That means in order for them to actually use your insurance to fix your car, you have to pay $500. Okay, and health insurance has deductibles too, so you might have a $1,000 deductible. Some insurances are crazy and have $10,000, $20,000 deductibles. So in other words, that's what you have to pay before your health insurance actually kicks in. All right, so it's a very important number to know when you're shopping and buying insurance, because the premium might sound really good. The monthly payment, you say, hey, man, I can really afford that. But then you find out what the deductible is, and it's really not worth it. All right, so there's 3 areas of risk that we cover, the insurance covers. Property, which would be something like your house, your car. Liability, the word liability, think of the word liable. If you're liable for something, do you know what that means, Cam? If I say you're liable for that, what does that mean? Want to take a guess? Do you know what the word responsible means?
Yeah.
Yeah. So if you're responsible for it, that means
You're responsible for the things you own.
okay, that's right. So you are responsible for something you own. So liability is basically saying you are responsible for damages you cause. So certain types of insurance is to protect you for something you might accidentally do to someone else. Okay. Then the last type of insurance risk coverage is personal. So it's be like health or life insurance. So we're going to go through some examples of each of these. All right. So some of the main types of insurance out there, obviously, number one is property insurance. This is going to cover damages or losses due to your destruction of your home or damage to your home. All right. So some examples where people use homeowners insurance or property insurance is definitely a storm, a fire, obviously floods or hurricanes. About 5-6 years ago now, however many years it's been, my house here in Channahon was hit by a massive hailstorm. Okay, it was like the 2nd or 3rd largest hailstorm they said it reported in Illinois history. Just about every house, including mine in the neighborhood, had to have a new roof put on from all the hail damage. So that's where insurance comes in. All right, it was about a $10,000 to $15,000 job to have the roof done. But because we had homeowners insurance, we had to pay our deductible out of pocket, which was like $1,000. So that's the important piece, right? I'd rather pay $1,000 out of pocket than $15,000 out of pocket. So that's how homeowners insurance would ultimately work. What your insurance bill for homeowners is going to be based on is this term replacement value coverage. So it's basically the value of what your house is worth and the things in the house you want to be insured. So if your property value goes up, you finish a basement, you update a kitchen or something, the value of your house goes up. So technically your homeowner's insurance premium is going to go up as well. If you have certain things in the house that are of value, you have certain artwork or heirlooms that have been passed down from generation that you want part of your insurance coverage, the insurance company needs to know about that. You can't, after a storm destroys your house, go to the insurance company and say, hey, I had this very expensive piece of jewelry from my great-great-grandmother. It's worth about $10,000 and expect the insurance company to cover that. They have to know about it prior to it. All right, and the homeowner's insurance is based on that concept. So what you're going to pay in your premium monthly or yearly is going to be based on that replacement value coverage and what you want covered by the insurance company. There's some pictures just representing some of the situations people would be in where obviously their homes would no longer be the same, and hopefully they had homeowners insurance, property insurance to cover the damages caused by these natural disasters. Pretty crazy, huh?
Ooh, yeah. That was really bad.
All right, a type of personal insurance would be life insurance, which provides coverage after the insured's death. All right, so this is kind of a morbid one to talk about, but essentially people with dependents, such as a wife or husband and kids, usually have the highest coverage, okay? And this is ultimately money that would be left behind to your dependents so that they can continue having some income to support them until they're able to find other money. There's two forms of this. There's term life insurance, which you pay just for a specific period of time. You might say, I'm going to buy life insurance for the next year, 5 years, and that's it. You pay it during that time period. There's no cash value to it when it's done. Once you're done paying it, that's not money you're going to see again. And then there's the one that's more expensive called whole life insurance. And this is one that you would, however much you put into this insurance policy, you would get something back upon the death of the insured. But it's going to be much more expensive because it's for the entire life of the person.
Tired.
All right, the next type of insurance, personal insurance, is health insurance. Probably one of the most expensive, but also most important to have. All right, so this is obviously going to cover treatments when you go to the doctor's office, the hospital, the ER, broken bones, like in the x-rays there, to babies being born. Most insurances come under two types. There's what we call a PPO and an HMO. As you can see on the slide there, the PPO is where you can pick your doctor and services. So it's going to be a little more expensive out of your pocket or your company's pocket if they're paying for your health insurance. But the PPO is going to be allowing you to pick where you're going to go to see the doctor, what doctor you're going to see. Where an HMO is going to be a little cheaper, but you have to get referrals. So if you want to go see a doctor for because you're having some kind of pain or something, you're going to have to get referred to see an orthopedic or some type of physical therapist or something like that. You can't just go because you don't have a PPO. All right, HMO you'd have to have that referred to then. Okay. And obviously this is something that you want to make sure you have, because under without insurance, health insurance, you go to a doctor, it could be very, very costly to cover some of those things. Now this is a handout we would usually go over in class, just looking at different types of health insurance that exist in the US, but also around the world. So if you're paying attention in the election stuff, they're talking about this thing called the single payer healthcare versus private healthcare. Okay, so the U.S. is mostly based on this type, private healthcare. Pros and cons of the U.S. system is because people are paying for it out of pocket or companies are paying for health insurance, there's a lot more money that goes into it. It's usually more costly, but the care is going to be much higher quality. Okay. The con is it's going to be very expensive. Where you look at some of the European models and some of the things that you hear in the debates is, everyone being on the exact same healthcare plan or the single payer healthcare system. That's going to be more people are going to have access to it. However, it's going to be cheaper out of pocket. All right, it's like it says there, it reduces overall coverage and medical costs of the individual, but it's usually going to come at the cost of expensive taxpayers. All right, taxpayers are going to have to cover the cost of that. So taxes might go up in certain areas or on individuals. Oh, our lizard disappear? Go hit your computer and we'll get it going again. All right. The U.S. has tried, you know, if you're familiar with this from about 8 years ago, well, more than that, 8 to 12 years ago, what we call the Affordable Care Act, or most people refer to it as Obamacare, was kind of a combination of the two. All right. Now I'm not going to go into, you know, everything in and out about it, but some of the debated pros and cons is it was good because it gave a lot of people access to cheaper insurance. However, the premiums were very affordable, but sometimes the deductibles were very expensive. All right, so that was kind of the debated pro and con. More people had access, but depending on where you live in the U.S., it could actually be fairly expensive for you to even have it. So you're talking $10,000 or $15,000 deductible. So yeah, you have health insurance, but if you got a $15,000 deductible, you're most likely not even going to use that. You're probably not even going to use the health insurance because it's so expensive. Okay. The other unique thing about the Affordable Care Act is it allowed, you know, this is going to refer to you guys, is you can be on your parents' insurance coverage up to the age of 26. Okay. So that kind of gives you some wiggle room while you're in college and trying to find a job to stay on your parents' insurance. Okay. When I was coming out of college, you know, out of high school in 2000, you had to be a full-time student in order to be on your parents' insurance. Okay. So there was a couple semesters where I wasn't a full-time student, where I was working full-time. So I actually went a few months here and there without health insurance, and that can be kind of dangerous at times. So that's definitely going to help you guys as you go through college and into the early stages of your career until you are able to cover your insurance on your own. Okay, go back to the PowerPoint. All right, the other type of personal insurance that we're going to talk about is disability insurance. For this is insurance that's going to put money aside for those who are disabled, born disabled, become disabled. Obviously, they need an ability to survive. You know, they need a place to live. They need money for food, basic shelter, and clothing. So disability insurance is going to make sure that those people have those basic needs covered. All right, and then the last one that I cover is the main one you guys really are probably more interested in, is the automobile insurance, because this is a form of liability insurance, okay? Because it's you having insurance to protect not just yourself as a driver, but to protect other drivers on the road. So this provides coverage for situations obviously involving automobile accidents. And there's a few types of auto insurance that you guys need to know, all right? And this is gonna be different depending on the insurance company you have, or as you go from Geico to State Farm, they might use slightly different terminology, how they explain their coverages and their plans, but these are kind of the basic terms that we'll go through. It's liability is the first one. This is like the bare basement minimum auto insurance you must have in order to drive legally in the state of Illinois, okay? If you're caught without insurance, this is why you're gonna get a big ticket, because if you were to get in a car accident while driving, you're not gonna be guaranteed to be able to fix that person's car that you may have damaged if the accident was your fault. So this is required in the state of Illinois to have liability insurance. Now, the key to understanding your basic liability insurance is it only covers damage you cause. So if I drive down the road and I run into the back end of your car, I'm at fault. I just caused damage to your car. If I have liability insurance, my insurance is only fixing your car. It's not going to fix my car as well. That's why they call it liability. It's just for what I'm responsible for. All right, it's going to be the cheapest form of insurance. So this would be, you know, if you're driving down the road and you see an insurance company, one of those storefront type of insurance, and it's like $20 a month for auto insurance. That's a great price, but it's probably gonna be pretty cheap and not much coverage. It's probably the very basic liability, and that might not even cover all the damage you cause. So if you cause $20,000 in damage to a brand new vehicle, your insurance might not cover the full $20,000. So you have to know not just the fact that you're driving legally, but what is it gonna cover? Then the two more expensive forms of auto insurance would be collision and comprehensive. All right, collision insurance is going to cover damage both you cause and the damage done to your car. All right, so that kind of steps it up another grade, and then the top grade would be what we call comprehensive, which would cover all damage, even if it's nature. All right, storm hits, hail damage to your car, and you can use your insurance to get the dents taken out of your car, even from hailstorms. Okay. All right, so the worksheet you guys are going to need to do today for covering insurance is going to go through a couple terms or a couple scenarios. If I can find that real quick. This is what it's going to look like. All right, so you got the scenario here. All right, and this is how insurance policies will oftentimes look. All right, you'll have three numbers here. So, instance 100, 350. The first number, the 100, is going to represent bodily injury per person in an accident if you're at fault. All right, so the 100 would refer to $100,000 of maximum insurance going payment towards individuals that you cause damage to, so 100 grand. The second number represents total bodily injury in an accident. So in this case, your insurance would cover up to $300,000 in total health insurance coverage towards damage you cause to another person or people. And the third number, the 50, refers to property damage. So the car itself, or if you run into something and you cause property damage. So it'd be $50,000 in damage your insurance would cover. Okay, so here's the scenario. I'll do the first one with you, and then you can go to the second page and complete the second one, as well as the questions, and then turn that in on Google Classroom, okay? So it says here, Mario carried 20, 40, 15 coverage, which is the very minimum, the state minimum, all right, to be driving legally. It says damages were assessed as shown below, and Mario was held fully responsible. Who paid what? Complete the chart, okay? So if he's got 20, 40, 50, we can know that the first number is how much money his insurance is going to cover per person. The 20 represents $20,000, all right, per person. And then the 40 represents $40,000 per accident. All right, so we can see that if the court awarded this amount of health damage or physical damage, bodily injury to each of these people that were in the other car you hit, you can see that what your insurance is going to pay compared to what you're going to owe isn't going to match up. All right, so your insurance is going to pay towards Sam's $95,000 bill. Your insurance is going to cover $20,000 of that. So you're still on the hook for 95 minus 20, $75,000. All right, and then for Mary, if you already covered 20, you still got 20 left to hit that total of 40. So your insurance is going to cover $20,000 towards Mary's bills, which covers, excuse me, covers it all. So you owe zero out of pocket towards Mary. Property damage caused in the accident, your insurance is going to cover $15,000 based on the number 15 up here. The court awarded that you have to owe $25,000 in damages. So your insurance is covering 15, which puts you on the hook still for, what is that, $10,000 left. All right. So your insurance is going to cover a total of 40, 20 plus 20 is 40, plus 15 is $55,000, but you're going to be on the hook for $85,000 out of your pocket. All right, because you had that very bare minimum, very cheap insurance, and the damages you'd cause were greater than what your insurance actually covers. Now, this is worst case scenario, doomsday scenario, assuming that's, Sam did not have any health insurance of her own or his own, and so you have to pay the full amount. Now, hopefully that person had health insurance, so you're paying their deductible basically and wouldn't have that huge of a bill, but that's a possibility if you have very cheap insurance. All right, so that's the scenario one. Go ahead and do scenario two. All right, same scenario, but now Mario's got a better plan, fill in the numbers accordingly, and then answer the questions that go with it. And when you're done, go ahead and submit it to Google Classroom. Okay, and that is our coverage of insurance. Say bye.